we're seeing a clear moderation in economic activity outside the U.S. We're obviously seeing major issues now with some emerging markets. We're seeing pretty poor performance in European equities, particularly European banks. So with 40% of S&P revenues sourced overseas, we can't keep performing the way we are if overseas is going to continue to perform the way they are. We need to reconcile this.
But is the reason, I mean, I understand the reconciliation argument, but doesn't that mean that the U.S. is just the best investment option available to people out there, and that's the reason why we are seeing the flows come here from a capital perspective?
I mean, that's certainly the case and why we're outperforming to the extent that we are. But again, because we're very reliant on global trade, 10% of the U.S. economy is exports. As I mentioned, 40% of S&P revenues are sourced overseas. You wonder how long that outperformance can take place in light of what's going on outside of the U.S. Plus, we're going to get another Fed rate hike at the end of the month. We're going to see in the fourth quarter the net liquidity injection between the ECB, the Fed, and the Bank of Japan go to zero for the first time in many years. It was running at $100 billion a month just in the fourth quarter of last year. So we also need to deal with that liquidity strain as well, in addition to what's going on in global economies.
So from a macro perspective, we understand what's happening with emerging markets right now and why there are stresses there. Some of them have been called idiosyncratic, Turkey, for instance, or Argentina. We've also talked about contagion and this idea that it could spread. What would lead to a contagion type situation? Not that we're even close to there yet, but we talk about these emerging markets all the time like they could take down the rest of the global market. What would you need to see for that to maybe manifest itself?
I have my eyes on the European banks. You look at a stock chart of the European Bank Stock Index, and we're breaking to the lowest level in a few years. And they're very exposed to a lot of these emerging markets. So where European banks go, in my opinion, will be a key thing to watch in how this whole emerging market distress plays out. But there's no coincidence that the issues with emerging markets this year are happening as that liquidity draw is intensifying as each quarter goes on, as the ECB gets closer to ending QE, as the Fed continues to draw more liquidity out of the system, and even the Bank of Japan has basically cut QE in half. We're going to see more emerging market accidents. Things happen when the liquidity tide goes the other way.